Disclaimer. This material in this presentation has been prepared by ADCM, LLC DBA Willow, and is general background information about Willow's activities, current as at the date of this presentation. This information is given in summary form and does not purport to be complete. Information in this presentation should not be considered as advice, or recommendation to investors or potential investors, in relation to holding, purchasing or selling securities or other financial products, or instruments. Neither the information nor any opinion expressed herein constitutes an offer or a solicitation of an offer to buy or sell securities. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risks. While due care has been used in preparation of this presentation, the information contained herein has been obtained from sources believed to be reliable, but its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside Willow's control. Past performance is not a reliable indication of future performance.
All right, welcome everybody.
Welcome.
Got a good turnout today.
Yeah.
We're going to just give it another minute and let any stragglers join.
Yep.
And then we'll jump in.
Yeah, and just as a reminder, if you have a question, please feel free to ask it in the chat box in the bottom, or similarly, I think we can unmute you so you can raise your hand, right, Paul?
Yeah.
Okay, so you can raise your hand and actually ask the question as well. But we have several that came in, thankfully. We love when we get these questions before we started. So yeah, so we have some good questions as well. Are we ready to roll?
So
We have to do our disclosure. So we always start with our risk indicators, and the first risk indicator here you're looking at is volatility. The top line for you here represents the volatility now that we are beginning to experience in the bond market. So this is one particular area that we both pay particular attention to, because bonds will tend to signal if there's any stress in the financial markets. So beyond the stock market, which is one place, but it's looking into loans and the security at the banks. So what we're starting to see is a little bit more volatility there. There's a chop here as well, questioning whether rates are going to go higher or not higher. So that's also playing out here. But when this trajectory starts to go in the upward direction, it continues to make us become even more cautious, which, if we've become very conservative over the last several months. We started this process in October and we continue to do so. So this indicator definitely confirms our direction.
Right, and the bond market is, I think, an order of magnitude larger than the stock market. So when stress starts to show up there, it's something that we absolutely want to pay attention to, and why we look. That's one of the main reasons why we look at this type of data.
Yeah, and just let me back up on one thing as well. So there's all different types of recessions that we can experience. Many of us, of course, remember the financial crisis. So the financial crisis was really a crisis in debt, and a crisis where we actually saw the potential for a lot of banks to really default and no longer exist. We've seen, for example, companies taking over other companies, because like Bear Stearns, for example, was on the brink and it was taken over by Bank of America. So there's that type of recession. That's intense, and that speaks to a great possibility of losing a lot of money. In fact, a complete collapse of the system was what we looked at in 2007, 2008. Go back in time, look at the tech bubble. When that tech bubble was pricked, yes, there was some stress in the financial sector and in banks, but it was really limited to what we'll call bad actors, companies that were not managing their balance sheet well, Ponzi schemes such as Enron,
all sorts of zombie companies that they weren't actual businesses, really just fronts.
Exactly.
Slap.com or something on their name.
So that recession was more of an earnings recession. So more, it was more contained. So we're not suggesting, because of this volatility, that we're looking at another financial crisis. It's just that what it's speaking to for us is that we still have to remain conservative in the stock market. And you'll see there's other indicators that it's never one indicator in a vacuum, as we always say. It's always multiple indicators that we look at. This is just one piece.
All right. These are default swap spreads. These are, again, sort of like a insurance on if a company is going to default. And when you see these spreads rise, the chart go up, basically, it means that the chances for default are pricing higher. The chance of a default in these companies increases. And again, it's really about the slope of these curves. Generally, they've been flat for a while, but it's really since what?
I think it's
probably around here. Oh,
yeah. Oh, you're getting ahead.
yeah, since November or so last year, we started noticing that there was some interesting movement happening in this space. And
yeah, and here you can see the
trended up
slope.
ever since.
Yeah,
Mhm.
so the slope, as Paul said, you can see the slope is increasing over the last few months, and in particular the last month. Now, again, never in a vacuum, but credit default swaps, if we see more of our risk indicators going in this direction, then we have to start asking ourselves, are we looking at not just a market correction, not just a recession, but are we looking at a problem with debt?
And
So
now, weren't these almost a
you-
leading indicator in the great financial
Yeah.
crisis? You could see these spreads started to really blow out
Yeah.
before
Yeah.
a lot of other
Yeah.
things came to surface.
Yeah, so Paul's correct. It was a leading indicator, but even more importantly, breaking out the sectors, which you don't see here. So we have to break it out sector by sector by sector by sector by sector to see where the stress is. So if you go back, like just a little bit of history, you go back to the financial crisis, you will see that the credit default swaps in finance was spiking. So that slope of the curve was exponential. But if you saw credit default swaps for other areas, like let's say consumer non-discretionary, that was relatively flat. That wasn't that bad at the beginning. So this is good, but then you have to get more granular. So
This is just looking at sort of the market as a whole, or an aggregate of all investment grade, high yields, and emerging markets. That's what these different lines look at.
So what I think I want to just back up and say is, yes, it is a good leading economic indicator. It's even better if you're breaking out the components, because sometimes the whole won't really show the full picture. Bond spreads. So bond spreads, this is the number one risk indicator in our work. This isn't significant enough, what we're seeing here, to say that there's absolute problems in the market. But this is data that cannot be manipulated, because this is real trades. This is actual bonds. Bonds have to report pricing. It's price report on where bonds are trading. So the greater the spread, meaning the more risk there is. So this shows the risk compared to US Treasuries to corporate bond, for example. Yeah. So the greater the spread, the greater the risk. This isn't, it's not elevated enough for us to be frightened. But again, we have to get granular, because we own individual bonds for you. So we have to look at spreads, not just as a whole, but each one of the bonds that we hold for you. So, in terms of importance, historically, this got me out of Fannie Mae before the financial crisis. This got us out of Bear Stearns. So we actually owned, for those of you who were with us, we owned Bear Stearns bonds. We owned Lehman bonds. But this very indicator, broken apart, allowed us to get out, not quite whole, but pretty darn close compared to what others experienced, which was zero. So
again, that's why we look at the data.
We look at the data. So, we don't care what CNBC has to say. We really don't. We care about what the data is showing us.
So
yes, this is a big.
We're going to do a webinar in the next couple months or so that focuses specifically on the dollar and all of the concerns and issues that we've been talking about really for the past decade. Here's a little tease. This is some news that came out recently that shows that Israel's central bank changed their philosophy. And while it might not look significant, in the past they had held mostly US dollars and euros, but going forward, they're increasing their basket of foreign currency. And it might seem like, okay, that's just a small change, but what this signals to the global community is saying that, hey, faith in the US dollar as the #1 reserve currency may be waning.
Yeah, this is a philosophical change, and this is something we've been concerned about for a number of reasons. Number one, the piece, again, the GDP piece of the pie that US holds is diminishing. It's going lower. So obviously the demand for our dollar would come down as our GDP pie comes down, but also as it shows that we lose a little bit of our let's say power, so to speak, economic power. So why would other countries, especially emerging ones, want to, only hold the US currency when we're a smaller piece of the pie? The other thing that is happening is with the war going on in Yugoslavia, Ukraine, excuse me. Oh my gosh, that was because I was looking at going to Croatia this morning and Slovenia. Anyway, so with the war going on in Ukraine, essentially, Russia has now demanded to be paid for their oil and their gas in their own currency or in gold. Okay, and Paul and I have been saying this for a long time, that the moment all trade in OPEC gets done in the dollar or euro, and mostly the dollar. So of course, the US is balking at the fact that they want to pay in their own currency. But you have to understand, this is a tide change that's happening across the globe. As that happens, the demand for the dollar goes down. And what happens when there's demand goes down? There's more supply. And then what happens? The price inevitably comes down. And what that means is higher cost to all of us in the United States. So this isn't just the dollars going down. This isn't just that it's not going to be the reserve currency, we believe. This is about us experiencing lasting inflation, if you will.
Yeah. I mean, this really is a proxy for confidence.
Yeah,
and if confidence in the US dollar as a global reserve currency is fading, the implications are significant.
Yeah. And Japan, this is a big deal, because this is a major economic ally of the United States, and to actually see them changing their target, this is not a small, not small. Yeah.
So this is a chart of the Dixie, or the US dollar index. And really what we're trying to illustrate with this chart is that during times of crises, this is the 87 crash.
There's what they called the Asian contagion back in the,
Normally, people would flock to US dollars during a time of crisis because it's seen as this stable reserve asset. But as we can see, during times of crisis, each time less and less global other dollars are flowing into US dollars. So the demand for US dollars during these times of crisis has actually been dropping. Over time.
So what you see is, like, any time of crisis, they want to own the dollar, right? This is the safest currency. It's the safest treasury, right? So you're seeing lower highs with each currency, with each crisis. So Paul, like that was 87. That was the tech bubble. Now let's look at the financial crisis right over here, right? And then we're here today, where the question mark is, where Paul's question mark. That's today. Now we're a little bit higher than we were in the financial crisis. Not enough for us to say that there's this trend reversal. So this is, in our mind, this is something we watch daily. What's again, in the past, there would be a war. Where would people want to be? They would want to be in the dollar. This is supposedly the safest currency in the world. So,
and this is also doubly concerning, because as this increases, it makes energy more expensive, right? Overall, because now emerging markets need to start pricing in dollars, and when the price of the dollar, when it costs more to use these dollars,
they'll go someplace else. I mean, they already are now. So inflation,
right? So we wanted to link in some past videos, but we had some trouble with that. But we can share them in the notes when we send the email out. You can go to our website. We have an update from September and a market update from November, where we talk a lot, and October, September, October, and November, where we talk a lot about inflation and how at the time the Federal Reserve was saying that, it was transitory, it was nothing to worry about. And we were saying, hey, there's something else happening here, and this does not look transitory, and it actually looks like it's something that unfortunately might stick around for a while. So these are charts that just show what current inflation rates are, and then what current inflation rates would be if they use the original math that they used to use back in the 80s, which is arguably a more accurate description of the costs that we're all feeling when we go out and shop for things.
Yeah, and for those of you, again, like what Paul's showing you here is if the basket wasn't changed. This is something called shadow statistics. So this is a calculation done by an independent firm that shows what the basket would be if they didn't change it from 1990 and what it would be if they didn't change it from 1980. So 1980 shows that we'd be sitting around 16% in inflation, and 1990 shows we'd be sitting at 13% somewhere in there. Yeah, 13% inflation. Now, we have a thesis, which we've had for 10 years, is we're going to experience something we call reverse stagflation. So maybe it's something a little bit different in that we think in the long run, we will be paying more for our necessities. And you're already seeing that. Food, we believe, is going to become a larger part of the household budget. We've been saying that a long time. Housing, same thing. Insurance, health insurance, education, that whole thing will become a larger part of the pie, and it has. And we do think that fees, taxes, again, if taxes were a stock, we'd buy it. We feel that that's just going to be a larger component, and there's just no way the Fed can control that piece of it. Okay, yes, consumable, non-discretionary items, sure, computers, we can see maybe some it decrease, but when it comes to necessities are necessities, and you have to have them. And the concerning thing for us is that we are seeing more and more stress at the lower income levels for people who just simply can't afford basic needs.
Right. The rises in these disproportionately affect those of lower income, because a much larger portion of their budget is needed to meet these basic needs and necessities.
And that in and of itself is not, it leads to a lot of instability. We have said that before. So
yeah, back in Q4 last year, we had a whole piece on what keeps us up at night. And one of the main things was this idea around social cohesion or civil unrest.
Yeah.
And these are the kind of things that feed into that.
Yeah, that was September. Yeah. Okay. Purchasing power of the dollar.
Yeah, I just wanted to show this chart of how, I guess the benefit of being the global reserve currency is that you kind of can print as much as you want until you can't, right? And this just shows what that has done over the past, this goes back almost 100 years, this chart. And where a dollar today is worth significantly less than a dollar back in the early 1900s. Some of these examples on the bottom are interesting, just where $1 today, or how does this? $1 buys 30 Hershey bars back in 1913.
Today, it's $26.14 for 30 Hershey bars. Not that I would want to eat Hershey bars anyway, but I mean, this is pretty interesting. This bag of pretzels, $1 for 10 bags of pretzels. Today, it's $9.69. So this is, this definitely shows, and what, if you can see the chart here, what it shows is the value of $25 now. Is what, Paul? A dollar. Yeah.
Index back.
Yeah.
A dollar
So
today is worth $25.
Yeah.
And just through policy and different federal programs, the move off the gold standard, quantitative easing, money supply growth, this is what has happened to the value of our dollars over time.
Yeah. Now, okay, so again, we've said this before. It's like the way we look at markets, it's a living and breathing organism. So it has an out breath and an in breath and an out breath and an in breath, right? So what this chart is showing you, the red line across is showing what we would consider support in the stock market. This is for the NASDAQ. If we see this level breach, which we are breaching today, yeah, we're pretty close. If this level breaches, Paul, can you show what we'd be looking at levels, the next level of support would be here.
60.
Yeah, and down. So what we don't want to see is this breakthrough, because then we'll see another, 10% down from there. And why is this significant? Because frankly, these charts are what helped us get more conservative in October. And again, it's not just the NASDAQ we're looking at. We're looking at all of the components.
Everything together.
Yeah. So what we were seeing in October, and we were stating this, is a breakdown in technology, which made us really take out the majority of our technology positions. And you can see that by way of capital gains last year, you paid a little bit more, but we don't regret it, because what we see in these charts, and especially as we break them down, is that the breakdown is continuing. And the support levels we think are getting reached.
Yeah, and you can see this dip here. This was the initial COVID dip that happened, and then
yeah, that's interesting.
Right from there, markets have shot straight up, but arguably the greater macro picture has shifted in many ways, and a lot of the data we're seeing is pointing to that, there's probably a higher chance that this continues down.
Yeah, this is interesting because Paul pointed out the COVID drop. What we're actually seeing in some of the technology, like for example, Amazon yesterday reversed, if you saw the chart, reversed everything it gained. It looked very similar to this, and it's all the way back to its pre-COVID rate. Price. So that's not just Amazon. That's Amazon. That's in Spotify, Zoom.
All the high flyers from that period
Facebook, right?
Given back almost all of their post-COVID gains.
And it's really typical when you start to see a toppling in the market. You do start to see it first in what they call the growth sector. That's the growth sector. Technology is considered growth. So yeah, if we actually showed you the individual components, which we scroll through every day, you would see that there's a lot of breaches all across the board.
Right, and the reason that really this isn't down further is mostly because those mega cap companies make up the largest percentage of these indices, and so they're holding up better than the super high growth, super high beta companies, which have been just absolutely pummeled.
S&P 500.
Similar chart, right? Here's the COVID drop, and then the gain sense, and so it's concerning.
So some of the support, we think there's a couple.
We do a lot of technical work on these charts, and to us, the setup here is just
and the reason we look at technicals, so is somebody knows something before everybody else does, and it plays out. So the market is a perfect, I would say, in 36 years of doing this work, it is the most perfect leading economic indicator in our work to give us an indication of where the economy is going. So, and as well as market.
I've always taken issue with the idea of efficient market hypothesis, where all data and information, everybody has absolute equal access to it, and it's always priced in exactly as it should be. It just, look at history. Just don't feel it works that way.
It doesn't.
Human nature takes its own.
You can clearly see patterns in trading. You can even sometimes predict when a company is going to get taken out. So, okay, so let's get to the questions.
Our slideshow here. We have a bunch of questions, so let me just get on.
So I'm going to hit the first question. We'll go to what are your target highs for gold and silver? So one of the things we want to make sure that we don't set targets in our work. We just simply don't do it, because I have always found that I'm going to be wrong. And I hate being wrong. It happens. But there's the saying, right? Don't fight the trend. Exactly.
Or a rising tide lifts all boats, or lowering tide lowers everything. Can always go down further, can always go up higher. So,
but let's talk about what we rather talk about is the macro trends that we see in that space. And as long as you have political unrest, as long as you have wars across the globe that are threatening all kinds of things, you are going to see a flight to what people consider safety. This is considered a safe place. And you're hearing that Russia is announcing that they want to trade their energy in gold or in their own currency. Okay, so what does that mean for the price of gold in the end? That's the first time we're actually having a serious conversation about a country using the gold for trading currency in many, three decades when we came off the gold standard, four, I can't even remember, 4, 5. Yeah. Time flies. But yeah, so rather than get a target price, what we can say here is that much of the macroeconomic trends that we're seeing are favoring this tangible asset. So that, and until we see a shift or a change in that philosophy, just like we're seeing the change in the philosophy of the dollar, right? We're not going to suggest a target for the dollar, but we are suggesting that it should come under pressure. Same thing here. We won't give a target, but we certainly feel that the macroeconomics are there to support potentially higher prices.
Yep. All right. So
you want to do that one?
Sure. Comment on the performance of digital assets. So as you know, we are into the digital asset space. We follow it very closely. It's a risk asset. So when the global macro sort of shifts to this higher uncertainty, more fear in the markets, these types of higher risk assets tend to go down quicker and faster than other things. So when you look at how these markets have performed, they're down. They've still held up considerably well, all things considered. I think people have called for the death of these markets every time they drop. I mean, what was it in 2017? Both Bitcoin and Ethereum were down something like 80–90%, only to then rally on to thousands of percent gains after that. So right now, it's a rough space for these markets. They are risk assets, so they're going to be much more volatile, and we fully expect that. That's why we have a long-term sort of view on this asset class, because the fundamentals for the projects that we follow anyways continue to get stronger. But if the global macro narrative in behavioral economics says people are not feeling safe or there's lots of uncertainty out there, those fundamentals don't matter so much in the short term.
So this question is, considering the losses of the first quarter, how do you see the market for 2022? Which new sectors will you invest in? So a good question. Again, Paul stated, rising tide raises all ships, no question, lowering tide lowers all ships. But when we speak of relative performance, the areas that are relatively performing well are those that will tend to do well in a recessionary environment.
More defensive things.
Yeah, more defensive, like food,
Staples, utilities.
Yeah, utilities, energy tends to do well now because of what's going on globally. There's that. Then there's also some pricing power we're seeing in insurance. Let's see, where else? Food, utilities, consumer staples, so household products. Yeah. That would be areas that tend to relatively perform well. But one of the things that you need to know, if things do unravel, it almost doesn't matter what stocks you own, really, because everything will feel the effect. But the question is, for how long? Like, will it be just a quick flash in the pan? But relatively speaking, we tend to like those areas, and we moved into a lot of those areas the end of last year and into this year. So yeah, we're already there. So that's a good question. Let's see, where do you want to go next?
You touched on the dollar.
Yep.
Any thoughts on T-bills?
Okay, so someone is asking the question around short-term treasury bills. We at this point prefer to stay short. That would be the best thing, we think, overall. We also like inflation protected securities. We think those are actually, depending upon which ones you're looking at, but short term is where we want to be. We're finally starting to see a little bit more yield in the short term. I mean, there was an announcement that the Fed would probably hold still for a while. Also, Wall Street expected a 6.4% print on inflation today. I didn't buy it. I don't think Paul bought that either. It turned out to be 8.2%. Inflation's not going to move that fast, not with all these externalities. It's just not going to happen that quickly. So I'm not of the mind that the Fed has stopped at this point.
Right. Because interest rates and bond prices are inversely related. if the Fed all of a sudden decides, hey, we're actually going to accelerate this and jack interest rates up significantly in a short period of time, it can severely impact bond prices. So there's still that type of uncertainty in these markets. That's again why we like to stay on the short end of the curve, because it is less affected by those kind of moves. And compared to what, 6 months, a year ago, the yields are starting to creep up in some of these assets. So I mean, obviously super short, a couple year treasury bond isn't beating inflation at 8%, but it's up to like the 2-3% range from basically zero. So there is I don't know if opportunity is the right word there, but there's at least something safe to invest in that provides a little bit of
relative opportunity. Again, like we're going to look at relative opportunity, maybe not absolute opportunity, but what's relative. So do you believe that the Fed's increase in interest rates will move too quickly and as the potential consumer sector stalls? So good question. And yes, historically, the Fed, the Fed has always been too late. Are they going to move too quickly? I think just the mere fact that they're moving in this direction is problematic for the market. The market never likes to see higher interest rates. So whether they move fast, whether they move slow, just from our perspective, we believe that a slowdown is inevitable. We've had such a long run, here without a recession. That just, and so therefore what I would say is the excess built up pretty exponentially. So whether they move slowly or quickly, I think
things always move in
cycles.
cycles.
I think they're gonna, it's ultimately gonna push us into a recession.
And the Fed's not bulletproof or foolproof either. They have these levers that they can pull, but what the actual impacts will be, it's nobody really knows. It's sort of a confidence game in a way, but that's for another discussion.
Okay, so the next one is the popular investment strategy focused on ESG has underperformed in 2022 first quarter. Do you feel that the logic and evidence for assurance of ESG driven alpha are lacking? So I don't know what data specifically you're looking at, but what we look at, for example, is let's just compare Just, for example, which is an ESG fund. It's down 7.96% over the last 3 months, whereas the S&P is down 12.50%. So that's, so there's that particular ESG strategy seems to be
right. A lot of the indices, the ESG indices that we track have almost identical performance to the regular stock market.
Yeah.
Now that said, our flavor of ESG is very different than what's marketed out there. I mean, we take a much more active approach to managing portfolios in general, which most of the ESG funds are based on exclusions. We won't invest in oil or most ESG funds are exclusionary based. They exclude entire sectors like oil and gas or defense or these other things. If you're not in those sectors, yes, performance has most likely suffered as these cycles have changed. So, our approach is I would say much more holistic, where we take a much bigger picture and look at not just one piece of data and say, okay, this passes or doesn't. We're looking at a whole wide variety of, the environmental impacts, how the internal workings of the company, the social impacts and governance and those kind of things. And it gives us back to our core thesis of really those companies that are forward looking and thinking about the future and treating their employees better are most likely going to outperform their peers who don't. And that's really sort of one of the cores of our
and also important, there's so many different types of ESG managers out there. Like, for example, I said Just, which is an ETF, they manage a certain way. They're only down 7.96%. Whereas another ESG fund is down 12.43% versus the market down the regular market down 12.5. So it depends upon what strategy somebody's using in ESG. I know from our perspective, as Paul said, we look at things a lot differently. And also because we tend to be macro oriented first, that's going to make us pivot into other ESG companies that we know are going to do well in the particular macroeconomic environment that we're in. Okay, so for example, like, food and energy, that was a pivot for us, and utilities, that was a pivot to us, and where we actually overweighted those particular sectors. So I think it just depends on what ESG funds you're tracking. The other thing is something we do want to share with you is for those of you who have a little bit higher risk profile, we've been taking some positions, and you may be seeing this, where we are going short the market. So like it's an insurance protection for you.
A hedge against downside, where should the market go down, these funds are inversely related, so they go up.
Yeah.
It's a way to hedge risk and provide some extra gain for the portfolio in uncertain times.
Yeah, some kind of insurance. So it really just, so to answer that question, it just depends how each of the ESG funds that are out there are positioned. So what do we have next? Is gold less desirable to own when interest rates rise because it has no yield, and thus making other yield-bearing havens like bonds more attractive? I wish bonds were attractive. I can't remember the last time bonds were attractive. I think, I was all excited, I think in the 90s when I was picking up a bond at 7% or 8%, or maybe even 6%, maybe even 5% made me excited. So, I think bonds have a long way to go to say that we're really excited about them. Again, just strictly from a relative perspective, why we like them right now is safety. It's not really about yield. And then gold, why we like gold right now is because of our view of inflation.
Our macro view would say that these kind of assets in general are safer to be in, at least for the short term.
Yeah. So the answer to that is, again, our macro perspective is going to trump, what's going on with interest rates at this time. So it would be nice though. Do you remember when we could get a treasury bond at 12%, 13%? Yeah. We would back up the bus and load it up. That I can tell you. Yeah.
So do you think with all the negative sentiments that markets are signaling that we're at or near the bottom? Right. I mean, so a lot of this comes back to our technical work too, but you overlay the technical where we're at some very concerning levels on the charts. Plus you add in the current macro view and landscape where basically we're looking for catalysts to lower the amount of uncertainty out there. And if anything, it looks like uncertainty is going to increase.
Now, having said that, we're due for a bounce. Okay. So like we said, it's a living organism. So it ebbs and flows. And we are in an oversold position right now. So this would be a catalyst for a great bounce in the market. And
just to give some flavor to that too, not saying that history is going to repeat here, but when you look at like the .com bust, there were at least 5 periods where markets rallied 20 to 50% on the way down for a total of negative 90% or so, 89% or something.
Same thing happened in the financial crisis.
Right, where you have this down, there's this big downdraft, and then there's this reflective bounce that can, unfortunately fool a lot of people or take a lot of people who think, oh, the tides have changed when actually they haven't. And you can see these 20 to 50% increases happen over that period to ultimately give all back up.
Could you do me a favor, Paul? Can you go back? Can you go back to the chart? I want to show something here. Can you go back to the chart with, I think, the NASDAQ on our presentation? Yeah, the presentations. So I want to show something because, I want to answer this question with just a little bit of history, and maybe next time we can put in some different types of charts. Oh, you're going to share screen. Okay, hold on. Here we go. Okay, I just want to show something here. This is what we called a V-shaped recovery right here. Bam and bam. Yeah. Can you? Oh, you get it right here. Thank you. Okay. That is extremely rare. Now, the only reason that happened is because what happened then was not about an economic slowdown. It was about the pandemic, which didn't necessarily show we were in a slowdown. It just obviously people panicked. That is a very rare recovery from any type of decline. very rare. What's more normal is what we call chop at the bottom, chop at the top. So consolidation. So like even here, you can see what we would call maybe a head and shoulders top in the market. Can you show that, Paul? Thank you. He's got a better, great, thank you. Yeah, that could actually be called a head and shoulders top, which would typically signal a greater decline. These same type of chart formations will happen at the bottom, double bottoms, triple bottoms, like in the tech bubble, we had a triple bottom. In the financial crisis, we had a light double bottom, but we had a lot of chop at the bottom.
And that chop is really a healthy thing for
it's
market
healthy.
as it sorts
It's
out
better.
what's good and what's not good, but then allows those companies that are positioned well to get where they need. And you want to see the longer period of consolidation or chop ultimately sets up for the next cycle or the next move in markets. And the longer those periods are, generally it allows for a greater next leg to happen.
Yeah, and getting to your question about negative sentiment, those tend to be short-term indicators, not longer-term indicators as well. So, you know, it's a great sentiment indicators, by the way, are great trading tools, right? So the sentiment is getting more negative now, quite negative. So that coupled with some of the things, again, Paul and I go at the micro level on these things, those along with some of the things we're seeing in the chart, to us as we're very close to what we would say like a oversold, a short-term oversold. Do we have some other questions? Okay.
All right, so when will growth come back?
This is a good question.
So we are definitely long-term believers in technology as a whole, that you know, that's what's going to really move us forward as a society and as a world. And it's just amazing what some of the innovations and developments that have happened to make life better for everybody, right? But where we really draw from is the macro picture. And right now, based on all the uncertainty, risk indicators, everything we're watching, we do not want to be heavily exposed to the growth sector yet. There will be a time that it will make a lot of sense to really get back in a big way. That time is not right now.
Yeah, you look at like Amazon, for example, trading back to what it was 2 years ago, and it's like, you know, it's tempting, you know, it has growth. It's definitely tempting, but it's just not the time. So growth, unfortunately, and I know you know this, the person who asked this question, it's a trade-off. It's all relative. So right now, it really is about being defensive. It's not about being, you know, running and making a home run right now. We are, like we said earlier, we are putting in defensive positions where we're going short when it feels right. We go short the market. We did a very short-term trade over the last week. We got in and out, and those things we know. So you're going to see a little bit more trading in the portfolio. So understand this. And this isn't a fun, like, don't get us wrong. It's not fun to see what's happening, but it's also important for us to be real, you know, and be realistic about the fact that sometimes it's not about growth. Sometimes it's just about being conservative and waiting it out. I know we've been saying that for 6 months, but really that's where we are. We think we're different at this time. So we have another question. I don't think
that's it.
Okay. Anybody else for any more questions before we get rolling here? Okay. Yes, we answered everything.
All right.
Okay.
So, you know, should any questions pop up, always feel free to give us a call, shoot us an email, or reach out. If you'd like to have a meeting with us, also feel free to reach out, give us a call.
And if you know, maybe you're shy to ask the question here. If there's a topic you want us to cover, if there's something more thoroughly that you want us to cover, say so, because we can do, like Paul said, we're going to do one specifically on the dollar. We're going to go and show you all kinds of charts, all kinds of data that will show you why we came to this thesis a long while ago. And what's interesting is our thesis of 10 years ago is playing out. It's playing out. So, and the data is only showing that it's continuing in that direction. So we want to do that. We think that's a really important piece of knowledge for, some education we think for people to have. But also, if there's anything else, please ask. We want to bring you along the process with us. Yeah.
Perfect.
Okay.
All right.
Thank you
Thanks,
so much,
everybody.
everyone. Enjoy this beautiful spring day.
Talk soon.